Hey guys, I just want to start off by saying that if you're not comfortable with the stock game, or you've tried multiple different stocks, but always seem to have your money go down or not get a good return on your investment, then you've tapped into the right video. So if you're new to my channel, my name's Nima. I'm a corporate executive with over 15 years of experience in both sales and finance. My videos break down complex financial concepts to help you on your financial journey, whether you're just starting out or if you're already a seasoned pro. So thanks for clicking in, and let's jump into today's topic, which is the 3 easy steps to make money in stocks with a 94% success rate. So I'll tell you right now, I've done a lot of research to figure this out, and I'm going to share it with you at no cost to you. So take this information and use it if you're serious about making real money with stocks. I personally am not gaining anything out of this. I just like helping people with finances and watching my YouTube channel grow. So stick around to the very end, because the third and last step of this video is probably the most important step to find out exactly what you have to do. So guys, the S&P 500 is the benchmark that most investors use to measure their performance. Now, if you're wondering, well, why is that the case? Well, it's because it's more diversified than the Dow Jones Industrial Average, which includes just 30 companies, and diversified more than the NASDAQ Composite, which focuses on the technology sector. Now, if you don't know this already, the S&P 500 is a collection of 500 of the highest quality US companies, and they have to meet a strict set of criteria for their inclusion. Now, these are the 3 things that they each have to follow. First, each company must be listed in the US with at least 10% of its shares available for public trading. Second, each company must have a minimum market valuation of $14.5 billion. And third, the sum of each company's earnings, or profits in this case, over the most recent 4 quarters must be positive. Now, the index has a long track record of success dating back to its establishment in 1957, delivering a positive annual return in 52 out of those 67 years. However, history also proves that the longer you remain invested, the higher your chances of earning a positive return. In this video, guys, I'll go ahead and outline 3 simple steps every investor can take to maximize their potential for stock market gains. So let's go ahead and start with the first. Step 1 on my list: buy an S&P 500 index fund. Building a portfolio of individual stocks can be a rewarding learning experience, but investors can also buy one of many exchange-traded funds, also known as ETFs, that directly track the performance of the S&P 500. After all, guys, the S&P 500 features almost every stock an investor could want, including what is known as the Magnificent Seven. These are the technology giants that have outperformed the index in 2023. So let me go ahead and give you those Magnificent Seven companies that you can feel safe investing into. Those companies are Apple, Microsoft, Amazon, Nvidia, Google, Meta, and Tesla. Now guys, those 7 companies are worth a combined $12 trillion, and they account for 28.1% of the S&P 500 by value, so they have a huge influence over its direction. But I want you to know that the index also hosts companies from almost every other sector beyond technology too, and that's everything from consumer products to energy resources. Now, since 1957, the S&P 500 has delivered an average annual return of 10.26%. And that's assuming that all dividends were reinvested. Now, just with this statistic alone, that's enough to double your initial investment every 7 years. So guys, just think about that. Doubling your investment every 7 years just by investing into the S&P 500. Now, here are 3 popular ETFs that directly track the index's performance. First is SPDR S&P 500 ETF Trust. The second is iShares Core S&P 500 ETF. And last but not least, the Vanguard S&P 500 ETF. Now, each one of these can be purchased as a single security through most reputable online brokerage platforms. Alright guys, now before I dive into step number 2, which describes what it takes to maximize your chances of making money with stocks. If you found this video helpful so far, I'd really appreciate it if you could smash that like button, leave a comment down below, and subscribe. Just remember that your support helps this channel grow, and I'm all about providing free and helpful content without charging for a course or anything like that. So guys, please show some love by smashing that like button, commenting down below, and subscribing. Alright guys, so as promised, step number 2. Hold on to your investments for at least 10 years. Now guys, this step obviously requires no action at all. Once you as the investor have decided which S&P 500 ETF to buy, you should just let time do the rest. As I touched on earlier in the video, the odds of making money in the stock market drastically improves the longer that you remain invested. There is a global investment manager known as the Capital Group that analyzed 94 years worth of data to prove that the longer that you remained invested, the more money you made. Just go ahead and look at this chart breakdown. If you held your money for at least 1 year, you had a 73% chance of making money. And if you held on to it for 10 years or more, it would increase to 94%. Now that's a pretty significant change over the years. But guys, I will mention, while the odds of making money are pretty good over a 1-year period, short-term investing is never a really good idea. For starters, it's impossible to predict which years will join the 27% of people losing money. Any number of negative shocks could happen inside a 12-month period. Things like high inflation, rising interest rates, and geopolitical conflicts can really unsettle the market. In fact, investors were dealt all 3 of those issues just in this past 2022 when the S&P 500 plunged down 18%. But I can say that time can smooth out all of that noise. To date, no crisis has lasted forever. Not even the COVID-19 pandemic could hold the market down in 2020, despite it being a once-in-a-century event. So guys, with all of that in mind, investors should definitely factor in a long-term hold the next time that they enter the market. And guys, as promised, last but not least, step 3 to making more money in stocks, and that is to consistently add to your investment. Building wealth isn't just about making the initial investment, it's about nurturing it over time. Once you've actually invested into the options that I provided earlier in this video, consider setting up a regular contribution plan to add more funds to your S&P 500 investment. This strategy is actually known as dollar cost averaging, and it involves investing a fixed amount at regular intervals regardless of the market fluctuations. By consistently adding over and over into your investment, you can potentially benefit from buying more shares when the prices are low and fewer shares when the prices are high. Ultimately, this smooths out your overall investment cost over time. And I'll go ahead and quickly explain how this works. Let's say you decide to invest $500 into an S&P 500 ETF every month. Now, some months the market might be on a high and your $500 might buy you fewer shares. But there's going to be other months where the market is actually down and $500 can buy you more shares. Over time, this approach averages out the purchase price of your shares. For instance, in a month where the market is booming, your $500 might buy 10 shares. However, in a market downturn, the same $500 might actually buy you 15 shares instead. But as a result, your average cost per share over those several months might be less than if you had invested a lump sum at just one single point in time. The beauty of dollar cost averaging is that it removes the need to time the market. Instead of trying to predict the best moment to invest, you steadily just keep buying into the market over time, benefiting from its fluctuations without the stress of trying to perfectly time your investments. By consistently adding to your investment through dollar cost averaging, you potentially benefit from the market volatility. This strategy allows you to accumulate more shares when prices are lower and fewer shares when prices are higher. ultimately smoothing out your overall investment costs. So again, guys, just to summarize the entire video. Step 1, invest in an S&P 500 index fund or ETF, gaining exposure to a diverse array of stocks, including major tech giants through accessible ETFs like SPDR S&P 500 ETF Trust, iShares Core S&P 500 ETF, or Vanguard S&P 500 ETF. Step 2, commit to a long-term approach, aiming to hold on to your S&P 500 investment for at least a decade. History shows that prolonged investment periods significantly increase the likelihood of positive returns, mitigating the impact of short-term volatility. And last but not least, step 3, regularly contributing to your investment. Consider a consistent investment plan to add funds at fixed intervals, potentially benefiting from market fluctuations and stabilizing your overall investment cost over time. Guys, by blending these steps, diversification through an S&P 500 investment, a long-term mindset, and consistent contributions, you position yourself for potential growth while navigating the market's fluctuations more strategically. I want to go ahead and thank you guys for watching this video all the way through. If you found this video helpful, please go ahead and share it with anyone who's interested in making safe and secure money in the stock market. If you have your own financial experiences or suggestions, please don't hesitate to share them down in the comments below. And of course, guys, don't forget to hit that like button, subscribe, and ring the notification bell for more videos every single week. I'll catch you guys in the next video.